Well, good afternoon, everyone, and welcome to our webinar, Tax Saving Strategies to Help You Weather the Storm. I'm Stacy, and I'm the Firm Marketing Manager for James Moore & Company, and I'll be your host for the webinar today. And with me today to present is Suzanne Forbes, CPA and Real Estate Lead Partner for James Moore & Company.
Good afternoon, everybody, and I'm looking forward to presenting this afternoon and hoping you're going to learn a little bit more about the impact of the hurricane and how to put some tax money in your pockets.
Thanks, Suzanne. And for those of you who haven't had the pleasure of meeting or working with Suzanne, she focuses her career on working with developers, hoteliers, asset managers, lessors, and real estate operators. She's basically the firm expert in all real estate related matters. And in addition to that, she also advises on areas such as transition planning, business acquisitions, mergers or dispositions, profit enhancement, and so much more. So during the webinar today, we're going to assume that everybody attending has probably suffered some sort of damage during the recent hurricanes. And with that in mind, we'll be discussing your frequently asked questions and also help you find ways to recover some of your losses. But before we get started with the presentation today, I just want to address a few items. So we encourage you to ask questions throughout the presentation, and you can do that by using the chat function in the lower right-hand corner of your screen. But do keep in mind that we're going to be addressing all the questions at the end of the presentation, and we're going to try and get through as many of them as possible. So if your question goes unanswered, we'll be sure to follow up with you later. And also, if you encounter any sort of technological problems during the webinar, please call the number on your screen and request webinar support. So without further ado, Suzanne, how can our listeners recover some of their losses from, the recent Hurricane Matthew and Hermine?
Well, thank you, Stacy, for that introduction. And so what we're going to talk about today is, first thing is, what is a casualty event? We know that the hurricane was one, but there is some specific definitions about why this is unique, why this hurricane has an impact different than normal losses. We're also going to talk a little bit about the differences between personal losses and business losses because they are handled differently under the tax code. And we're going to talk about what happens from insurance proceeds if you did receive insurance proceeds and that you were covered and what the tax impact is of that. And then both hurricanes were presidentially declared disaster areas, and that brings in another set of rules that are very important to the topic. Once you understand the basics of how you can deduct your losses and whether your insurance proceeds are taxable or not, then there's some additional rules because it was a declared disaster area. So with that, let's go ahead and talk about what is a casualty event. The definition of them is it has to be an identifiable event, it has to be damaging, and it has to be sudden, unexpected, or unusual in nature. So a hurricane is considered a casualty loss. So that's different than something, for example, termite infestations. That's one of the examples they give. That's not as sudden or unexpected or unusual. It's kind of a long, gradual loss. The definitions generally for a casualty event is a fire, storm, theft, and shipwreck. Just in case any of you have any ships out there, a shipwreck is also considered a casualty event. One thing that is not considered a casualty event is mold. So sometimes I will get a question about, well, what if I have mold as a result of a hurricane? So I get water in my house and I get mold that grows. That, if it's associated with a casualty event, it is considered a casualty event and it's covered under these rules. If it was just mold because there's humidity and we live in Florida and if you don't run your air conditioning every once in a while you get mold, etc., that's not a casualty event. So mold that's associated with a hurricane is a casualty event. I think that's pretty straightforward in this situation that we're talking about, the hurricane losses. But if you were to have some other loss, like a theft or a fire or something along that line, a lot of these rules that we're going to talk about today do also apply. So next is, what is a personal casualty loss? And a lot of times think of personal losses, they think it's not just your house, your personal residence. Most people know, okay, if I have damage to my home, that's personal loss. There are other personal losses, such as your vacation home, if you don't rent it out, if you have a second home, your vehicles. So sometimes in hurricanes or floods, we see a lot of damage to vehicles, jewelry that may have been destroyed in a fire, for example. Of course, my favorite is a boat. In case you are shipwrecked, you can't really be shipwrecked without a boat. So a boat, a personal boat, would be considered an item that would cover for a personal loss. So just keep things interesting here. We have a polling questions. We have a couple polling questions, and I think, Stacy, you're going to go ahead and run that poll just to kind of get an idea what our audience had, what kind of losses they had.
Sure. So in just a minute, you're going to see the poll pop up on your screen. And we'll give you guys maybe 10 or 15 seconds to participate in the poll. Looks like we have a few more responses coming in. Okay, and let's take a look at the type of damage incurred.
Okay, so it looks like 20%, 29, actually it's small on my screen, sorry guys, had damage, and there's some business damages as well as damages to both personal property and business. So that gives us an idea of what kind of losses we're looking at, so which is good for this audience because we do have both. Okay, so let's talk about the personal casualty loss first. The first thing you have to do is you have to figure out what the property was worth before the casualty loss. Now, our great legislators in Washington said the way that you do that is you have an appraisal before the loss. Now, I'm not sure about anybody else in the audience here, but I know I didn't run out before the hurricane and say, oh, I need to get my house appraised. So the majority of people do not have appraisals of the property before the hurricane, a recent one. They may have an old one if they happen to refinance and stuff. So that's in the utopia of what the regulations say, is that you're going to have an appraisal of your home before the hurricane, and then you're going to appraise it after. So alternatively, you can figure out the amount of your personal loss is the way that most people think of it is what did I have to spend to fix it? That's the easiest way to think about what my loss might be, your cost to repair the damage. So if you did have an appraisal, you would take the fair market value before the property was damaged and then afterwards, and that would be the amount of your loss. Then you have to calculate, okay, so I know that my fair market value before the loss was $100,000, and after the hurricane it was $80,000, that's a $20,000 loss. Then you have to say, what did I pay for the property? Because your loss can't be more than what you paid for it. Again, generally this is not an issue if you're actually using, you're spending money to repair the damage. This really only comes into place when you're not spending money to repair the damage, because you can't write off more than what you've actually incurred to purchase the property. So that's kind of a floor. They basically say you can't have more loss than what you spent money on. So it's I call it a lower fair market value or cost. It's going to be the lesser of the two. So now that you've determined how much your loss is, that you figured out that, okay, it was $100,000 before the hurricane and $80,000 fair market value after, or I had to spend $20,000 to take care of all the damages, you then reduce it by the amount of insurance proceeds that you received. And so let's say in this scenario, my $20,000, I got $18,000 of insurance because I had a $2,000 deductible. So now that would be the amount of your loss. So in the perfect world, we would say, oh, that's my tax deduction. I have a $2,000 tax deduction. Well, not quite. Not in the land of the IRS. So what the IRS says is that now, This is a personal loss. This is not business, so don't be thinking about business. This is just personal. You have to take your adjusted gross income, referred to as AGI, and you can only deduct, you have to first take whatever your loss is. So in my example of my $2,000, I would have to take $100 off of that, and then I have to take 10% of my income, and I don't get to deduct it unless my loss is more than 10% of my income. So it's generally very limited on personal losses. They don't really like you to be able to deduct a personal loss. And that's kind of, they're saying you basically have to lose more than 10% of your income in losses before you can deduct any of it. So I know this is a little confusing, so let me try to take through an example, and hopefully this will make more sense once I look at an example. But let's take James's house here in Daytona, and it had a significant roof damage due to the hurricane, and it cost him $8,500 to repair the damage to the roof. He originally paid $250,000 in the house in 2011. He was able to claim on his insurance. Apparently he didn't have very good insurance at a $5,500 deductible. We all know these hurricane deductibles are big. And he had $3,000 of insurance. Very important, his 2015 adjusted gross income was $45,000, and his 2016, which is the year of the hurricane, is $150,000. So what is his loss? What does he get to deduct off his taxes? So we'll go through step 1 and 2, and James, like the rest of us, was too busy putting up hurricane shutters than to go out and get an appraisal on his home. So what he's going to use is the cost of repairs method to calculate the decrease in the fair market value. So it cost him $8,500 to repair his roof, so therefore his loss on the surface is $8,500. Then we know that he bought his house for $250,000, so there's no limitations. If he had happened somehow to have only bought his house for $5,000, which is unlikely, then he wouldn't have had he would have had a limitation. He receives his $3,000 of insurance, so he's ultimately reduced to $5,500 as his loss. Now, one thing I'm going to talk about a little bit later, but I'm going to go ahead and talk about it here in this example, is because we are a declared disaster area by the President, we can actually go back and take the loss and choose which year we want to deduct the loss, whether we want to deduct it in 2015 or 16. Now this is a very special provision for the hurricanes, and you're allowed to go back, even though the hurricane occurred in 2016, you can go back to your 2015 return and see if you have a better deduction in 2015. Now in this situation, I mentioned earlier that his adjusted gross income was $45,000 in 2015. He got a whopping bonus in 2016, so his income was expected to be higher, which was $150,000. So we choose to use the 2015 return, and he would actually amend his return, and he would have to say, okay, my loss was $8,500. I got $3,000 from the insurance, and therefore I have a loss of $5,500. I have $100 I can't take under the rules. Then I have to reduce by another 10%. So my total loss is $900. Now that doesn't, it doesn't equate to too much. It's a couple $100 depending on what your tax bracket is. But the important thing is we can look at both years. The other thing is, in prior hurricanes, Congress can get rid of that limitation of $100 and 10%. They did that, I think in 2005. I don't remember if they did it, I can't remember if they did it for the 2004 hurricanes, but Congress has not reconvened since the hurricane, so this would happen in January. So we'll be looking for this in January to say, did the Congress get rid of this phase out, this 10%, and this $100? Because if they did, then the deduction would be $5,500, and it wouldn't matter what your income level was. In that situation, you would actually take the deduction in the higher year because you would have a higher tax bracket. One reason why they allowed you to pick years was, say this hurricane had happened much earlier, well, it probably would have been a hurricane, let's say it was a tornado that had happened in February or March, they allow people to pick the year because people need the money sooner than later. So you can actually go back to 2000, the year before. And in the real world, it doesn't happen because, quite honestly, if you're dealing with these kind of losses, you don't have time to be worried about your taxes. This is the last thing in your mind. You're trying to preserve and protect your property. But it was Congress's way to be able to try to make some effort for you to be able to get some money in your pocket sooner than later. I think we are coming up on our second polling question here. And, whoops, that was about.
Yes, we do have our second polling question, Suzanne, and just in a minute you're going to see that pop up on your screen. So if you guys could just take the next 10 to 15 seconds and respond to that, we'd appreciate it. Okay, and we have a few more people voting, so we'll give you a few more seconds. And I'm going to go ahead and close the poll now, and let's take a look at the results.
It looks like we have 25% in real estate, and we have 75% in other. We specifically looked at real estate because we know that we typically have more property damage and not so much in healthcare, government, manufacturing, and everybody else is other. And I always love the others. It could be anything. So just to kind of give you a little bit of an idea, we do have some concentration in real estate. So I've talked about personal losses, and we're going to answer questions at the end. I know that it looks like we might have a question or two put in, so we'll come back to those at the end, and I may answer some of your questions as we talk about business casualty losses. So now keep in mind, these are losses that you've incurred to property held for business or investments such as a rental home, a building, equipment, spoilage, anything that is related to you operating your business. It could be, water. It was an article in the paper about a restaurant up in Ormond. They actually had one of our favorite restaurants, and they had sewer backup, and so, they had all sorts of damage to, the interior with their carpet and their chairs and tables, and so those are the kind of things that we're looking at. Anything that's being used in a business is considered a business loss. So for business losses, we have some other rules too. If it's a partially destroyed loss, then we're going to look back at that fair market value, the change in the value of the property before the hurricane and after the hurricane, or whatever you incur to replace, fix it, repair it. Business losses are a little bit different. There's no limitations. You don't have this 10% of $100. We don't have to worry about whether or not Congress passes that. But for individuals, that's a different situation. So once we figured out what our loss amount is, we also have to consider something a little bit differently. If it's a partial loss, you have that limit of your fair market value of what you paid for it. But if it's a total loss, it's a different situation for business because your loss may only be based on what we call the adjusted basis of the property, regardless of fair market value. For example, if it's a complete loss, we know we don't care about fair market value because it's gone, so it was destroyed before or after. So what you have to do is look at what you originally paid for the property, and then you've probably written off through depreciation deductions. And so the difference between what you originally paid for less your depreciation would be your loss generally on the initial, if you completely destroyed it. Now if you're replacing it, that's a different thing. Now your replacement cost comes into play, and it also interacts, and we'll talk just briefly here about how the insurance piece goes with this. So you kind of have a loss, you know what you've spent, you had to replace something, or you had to repair it. So in this situation, and then you're going to get insurance proceeds. So Stacy, she has a personal boat. Remember I was talking about shipwrecks, but hers didn't get shipwrecked, it got hit by a hurricane. So her boat was worth $11,000 before the hurricane. I guess, she got on internet and checked it out on whatever blue book it is for boats. She had bought it for $25,000 in 2010, and she got $9,000 for insurance. So her loss is the $11,000, which is what the boat was worth before before the hurricane, and the $9,000 insurance. So she has a loss of $2,000 on her boat, and it's subject again to the 10% and the $100 limitation. She may not actually be able to get any tax benefit from it. Now let's take all good CPA firms like James Moore and Company. We always have business boat because we need to have a boat. And so our boat that we use for business was, because you didn't know that we were also in the charter boat business, was worth $11,000 from the hurricane. We paid $25,000 for it in 2010, but we had taken $20,000 in depreciation deduction on it in the previous years. So our cost basis on it now is $5,000 because we paid $25,000 for it, and we took depreciation of $20,000 on it, and we had a cost basis. But we were actually lucky because we had some pretty good insurance coverage, so we have $9,000 of insurance proceeds that we could have a potential taxable income of $4,000. That's the difference between the $9,000 and the $4,000. I'm going to say potential because there's some other rules about whether or not the proceeds are taxable. Because if we replace that very important boat that we use for business, we might, and we spend at least $9,000, we may actually be able to defer the gain on that insurance money that we got. So even though my insurance money exceeded what my original boat cost, as long as I replace it, and I'm going to talk a little bit more about the replacement property and the rules related to that because it's really critical. As long as we are replacing it, then we might be able to defer that income. So we have another polling question here. Keep you guys paying attention. Stacy, you want to go ahead and pull up that poll?
Sure. You guys should see that in just a minute. And for our third and final polling question of the day, we thought it would be fun to have some Florida trivia for you all. So we'll give everybody a few more seconds to answer the question. All right, and we're going to close the poll and let's take a look at the results.
Wow, you can tell everybody lives in Florida. Yes, believe it or not, it is June 1st through November 30th, even though it feels like it goes on forever. So good job, everybody. We all know when our hurricane season is because we all have that sigh of relief on November 30th. So I want to talk a little bit about the insurance proceeds because this is pretty critical. Back in 2004, we dealt with this a lot with the hotels on the beach where they had significant damage and they got a lot of insurance money in. And so the rules, you can replace your property. Now, there are other types of rules. There are rules related to being able to do this replacement property, and it's called, some of you may be familiar or heard of the term a like-kind exchange. Sometimes people refer to it as a 1031 exchange, but a like-kind exchange is one where you're able to take the money coming in and you can replace it with your property, and you have all sorts of rules and restrictions about how you touch the money or can't touch the money. And there's a rule that's a 1031 exchange. There's also a rule called a 1033 exchange, which is an involuntary conversion. And an involuntary conversion can be a situation where you have a theft or something like that, or a fire. It can also be a hurricane. It could be, a lot of times we see it with eminent domain, like a taking of property by a DOT where they're doing roads and stuff. And I have a client that's in a convenience store business, and the DOT came in and took part of their right-of-way, gave them a bunch of money, and we're able to do replacement properties, and we can defer the gain. This involuntary conversion, or hurricane, is considered an involuntary conversion, which allows us to use replacement property. And in addition to that, when the property is in a declared disaster area, we have some even better rules on this, because generally, if it's not a declared disaster area, it's very restricted. You have to have similar or related service or use, and one of these is a situation where they were saying like a billboard center with a billard center, like a pool hall was destroyed, and they replaced it with a bowling center, and they said that was not similar or service or use. Under a federally declared disaster area, it would be. So it is definitely a much more relaxed definition of a replacement property. Another situation where, an example, they talk about a floating seafood processing plant. So that kind of sounds like a boat to me. I'm kind of hung on boats today, aren't I? A floating seafood processing plant. Anyway, it was destroyed, and it was replaced with a land-based plant. And under the regular rules, it did not qualify, but under the declared disaster area, it did qualify. So we have a much more lax set of rules about replacement property. So we have to figure out whether or not I get this insurance money in, I need to replace it, does it qualify for replacement? And this has been interesting because I've come up with a lot of different questions on this. So the general rule is that if it was just a fire or theft or something, it would be 2 years from the end of a taxable year. So in this situation, if the fire occurred in 2016, you would actually have to have it replaced by the end of 2018. So let's say the fire occurred in February of 2016. You wouldn't have to have it replaced by February of 2018. You actually get through you get 2 complete taxable years. So that's a general rule for like personal items. 3 years if it's real estate used in business, 4 years if it's a personal residence, but most important for this audience is you have 4 years from the end of the year because we're in a declared disaster area. So that's another provision that says if you get that insurance money, and remember the $4,000 I got in from my James Moore boat, I actually have 4 years, and that would be 17, 18, 19, 20. Y'all can't see me, but I am counting on my fingers. So through the end of 2020, so December 31st, 2020, to replace that boat with the proceeds. So it's pretty generous, and also it is. They allow you under certain circumstances, like there were issues where with the last hurricane in 2004 where sometimes it was more than 4 years, and it is, keep in mind it's from the year that the insurance proceeds were received. So, but sometimes what we had was they got some money in 1 year and then they were fighting the insurance company, and then it was 3 4 years later before they got the rest of the insurance proceeds. So on the surface, it sounds like a very simple, I've got 4 years from the date I get my insurance proceeds, but on some larger claims, you can have multiple years that you're getting insurance proceeds in. So I mentioned earlier, when can you deduct your loss? And it can be deducted generally. It's deducted in the year which the loss is incurred, but because we're in a federally declared disaster area, you can possibly deduct it in the preceding year. So in our example of either Hurricane Matthew or Hermine, that you could have possibly deducted in 2015, and you have to go back and amend your tax return. And when you do the amended tax return, you specifically put in there that it's on the top of the tax return when you amend it. You specifically say it's Hurricane Hermine or Hurricane Matthew, and that allows them to know that it is related to the disaster area and that you're amending it back. There are some other rules related to disaster areas. One thing that comes up is questions about cost of living and repairing personal residence or replacing its contents, those type of FEMA monies and things like that that come in, and those are not considered taxable in federal disaster areas. Sometimes I do get a question about, well, what if I had to buy a generator to have power while the hurricane was out? Can I deduct the cost of that generator? And generally the answer is no, because it's a capital asset. So it's an asset that has a life, more than just this hurricane. So if you had to go buy the fuel and you had, some temporary living expenses, maybe under the situation of a casualty loss you could deduct it, but you can't deduct a capital asset because it has more than a life. I mentioned already that the disaster area is the 4-year replacement period that you have as opposed to potentially a 2 or 3 year. The definition of replacing the property with your insurance proceeds is much more relaxed than if you were not in a disaster area. So we look at that. We're still waiting to figure out whether Congress will get rid of that casualty loss, the 10% limitation. That's going to be a big issue as soon as, and I can guarantee you as soon as, if it does get passed, we'll be sending out an e-blast to say, if you have those casualty losses, because I've had a few calls from clients, and when I say to them, you got to have more than 10% of your income, so they got to have more. Let's say they're making, $60,000 a year, they got to have more than $6,000 before they get to get any benefit, and a lot of times net of insurance proceeds, it's not worth it. But if you have a 3% deductible on your insurance, you can, then you have some loss. So in 2004, I had a client that was on the river, and they had they lost a lot of their property, their actual land, because it went into the river. The retaining wall gave out and those items. And interestingly enough, that was not covered by insurance. Insurance never covers landscaping, and they had to bring in tons and tons of sand and dirt and rocks to rebuild that area of actual property, their real estate. And that was a significant loss. Fairly high income taxpayers, so that 10%, if they were, I think they were in excess of $250,000 a year, that was $25,000 that was not deductible, because of the 10%. So we are looking for those type of additional relief in addition to some of the things I've talked about. Being that the hurricane hit, I think it was October 6th, for some of our late filers, people that didn't quite have their tax returns filed before October 15th. I did get a call from a client who held a lot of real estate, 2 days beforehand, who was always one of my late filers, and said, well, it looks like I'm going to be getting an extension. Yes, you do get an extension. So if you were impacted by Matthew, for 2015 return, we actually had until March 15th, and for Hermine, it was January 17th. Some other provisions, too, that on extensions of returns, the March 15th deadline does not extend filing of W-2s or 1099s that are going to be due January 31st, but there's some other forms also that gave relief if somebody was late on payroll tax deposits. So there's some, if anybody has any issues with anything that happened between, within the 30 days after Hermine or Matthew, usually you can pretty much get penalties waived, a lot of good relief there because we are in a go and ask the IRS for a penalty abatement. And so sometimes we use that even maybe if it wasn't a direct impact, but if somebody was late on a payroll tax deposit or something like that and they were impacted, they might have been distracted or things like that. So we do try to be very aware of what is going on with a client that may be impacted by the hurricane. And anybody that's in Volusia County and Flagler County, Leon County up in Tallahassee, any of those declared counties, these disaster reliefs apply, and sometimes you'd be surprised that they apply and you don't necessarily think about it. It might be some other situation that comes up that impacts that. I think I've covered all of the special rules, and we wanted to allow some time for some questions, and I think we're on good track here to be able to answer a few questions for a few minutes here.
Yeah, thanks, Suzanne. We do have some time to answer some questions, and we've had a handful that have come in, so I'm glad we have this time to respond to everyone's questions. But thank you for all the information that you've given us during the webinar. I feel like you've given our listeners not only a lot to think about, but also numerous ways to put more money in their pocket, and that's why we're all here. So for our first question, and this one probably impacts a lot of you, I have 3 large palm trees on my property which were broken. Can I deduct the cost of removal, and can I claim a loss?
Okay, well that's a good question, because I know I had trees down on my property that had to be cleaned up, and so we talked a little bit about fair market value. Technically this is what the IRS says. It says you should appraise your property, not the trees, but the actual residence with the trees on it before and after the hurricane. And if you do that, I'm not sure if 3 palm trees would necessarily impact the fair market value of your property. It might be difficult to do. And again, like I kind of mentioned, nobody went out and got appraisals before the hurricane on their property. So more than likely, you're going to use the cost of cleaning up and restoring the trees, the residential property, as your loss. So the answer would be, if you generally, yes, you would use your cleanup, and you would use, if you actually are going to replace them, but you're going to be subject, if it's your personal residence, you'll be subject to that limitation unless Congress gets rid of it, so you'll have to incur more than 10% of your income to deduct it. If it's a business property, let's say it's a hotel, and you've got palm trees out in front of the hotel, well then it's just going to be deducted as a part of repairs, and comes under the regular rules of whatever the repair is. Keep in mind, just because maybe that tree was there for a long time, maybe a big majestic oak tree, you can't go out and say, oh, if I were to buy a majestic oak tree that was 50 years old, it would cost me $10,000. You don't get to go deduct, oh, that's a fair market. It's not the fair market value of that tree. It's the impact on the property as a whole. And if it's business, then you're going to be able to deduct the cleanup with no limitations, and that's generally what we would see from a business standpoint.
Okay, thanks, Suzanne. We have another question from one of our listeners who unfortunately lost $500 worth of food due to the loss of electricity for 4 days, and I'm sure a lot of us can relate to that. And in addition, they had to purchase a generator. Are some of those costs deductible?
Well, the food spoilage most likely was probably a personal expense. And again, if, yes, it is deductible, but you'd be subject to the limitations of the 10% unless you can get, clean that up. And Congress doesn't do that. If it's a, if it's a business, if it's a cafeteria, it's like for a business and they lost their power and they had food, the replacement, probably the food was already written off when they bought it, and then they get a deduction for replacing the food. So at a business, yes, they would get the deduction for the food. I mentioned already the generator. Most likely the generator is going to have to be capitalized unless it's a small item, which is another whole webinar on the new capitalization rules. Generally, for business, you might be able to deduct it if it was under 2,500 or whatever your capitalization policy is. Otherwise, it has to be capitalized as an asset.
Okay, thanks. And the third question coming in here relates to a condo association that made a special assessment on owners to replace uninsured damage due to the hurricane. Can the homeowners claim a special assessment as a casualty loss?
Well, that's a really interesting question, and I did deal with this back in 2004. You have to look at the underlying special assessment. So if the special underlying assessment was for just cleanup, then portion of that assessment may be deductible, just like a regular operating assessment is for the association. But the majority of those special assessments were for capital in nature. So then you have to look back and to see who owns the the property that was replaced. So if it was a roof on a condo association, then you'd actually have to say who owned the condo association roof. Generally in Florida, most condo associations, the roofs are owned by the association as common property and not by joint tenants in the entire, by joint tenants. And so the IRS rule on this is that if it's common property, then you cannot deduct the special assessment. It just becomes a capital item and added to the cost of the property. And so that's, if generally in Florida, I'd have to look at, if it was outside the state of Florida, we'd have to look at maybe a different rules as to how the property is owned.
Okay, we have a couple more questions left, and this next one is really interesting. So I have a house that I bought to resell in a few years, and I don't use it personally, and I also don't rent it. I don't report the house on any tax return since I don't have income from it. So how do I deduct damages due to this house?
Well, it's a good question. I would probably ask you, are you deducting the interest or the real estate taxes on the house if you have a mortgage? And one question would ask me is if you're deducting the interest as second home, that would tell me that you're treating it as a second home, a personal residence, and then it would just be a casualty loss. If you're taking the interest as investment interest, then what it would be considered a miscellaneous itemized deductions, but it's not limited to, like, generally they're limited to 2% deductions, and you would come under that casualty loss. In any case, it would, unless you were treating it on a rental property, which you just said you weren't putting it on your tax return anywhere, if it was a rental property, then that would be a different situation. You'd have a better deduction for it. But since it's not a rental, it's just a personal casualty loss, and either that or investment casualty loss. But in both cases, it's going to be limited to the casualty loss limitations of the 10%.
Okay. And the last question that's come in so far relates to business traffic declines, and I'm assuming a lot of business owners in the area suffered from this. So this attendee just wanted to know that, or to say that he didn't have any property damage, but his business traffic declined due to the hurricane. So can I deduct loss of income?
And this is a very common question. It's a good question. And I always kind of go back to eventually, and somewhere in my life, I knew when I was in high school I'd have to use algebra because this ends up being one of those, like, algebraic equation that goes in a circle, because basically the answer to that is no, you can't deduct loss of income. And the reason why is because you never picked it up as income. And by the loss of income in itself, you have more expenses than you have income, so you're having a tax deduction. So let's just say, normally I'd have, for one day I'd have $1,000 worth of revenue, and my expenses that day were $300. So overall, I would have made $700. So that's in a normal situation. Is I would have had $1,000 of income, $300 in expenses, and my profit would have been $700. Well, in a situation, let's say that you still had the $300 expenses that day, but you only had $100 worth of revenue because your traffic was reduced. So now you have $100 worth of revenue, you have $300 worth of expenses because they're still the same, and you have a $200 loss. So you, in effect, got to deduct the fact that you did not make $1,000 because you have a $200 loss versus a $700 profit. Otherwise, what you'd have to do is you'd have to pick up the $900 difference, the 1,000 versus 100, and increase your income, and then you'd have a deduction for $900, and you'd still end up in the same place, which is a loss of $200. So what happens is you take all your deductions, you just don't have the income because you didn't have the traffic, and definitely have seen that happen.
All right, well, that was the last question that was submitted. We still have about 10 minutes, so if anybody else has a question, feel free to submit that. But as you all know, or maybe you don't know, James Moore and Company, we maintain a dedicated real estate services team comprised of CPAs and consultants who really focus their careers on assisting individuals and businesses with all real estate related matters. And some of the services we provide are listed on your screen. So if you need help with any of these or more, don't hesitate to reach out to us. And it doesn't look like we've had any more questions coming in today, so it looks like we answered everybody's questions. But if some of you are still unsure about whether or not these tax strategies will work for you, or if you need help implementing any of them, we really highly encourage you to reach out to Suzanne. I know that she would be more than happy to help out. And her contact information is listed on the screen. So thank you all once again for attending our webinar, and we hope you have a wonderful day.
Thank you. You have a great day.